Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
Welcome to another Freedom Financial Friday. I've got Ava Bouwkamp here with me. We're going to be talking about the red wave.
Hey Mavericks, this is Ava Bouwkamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
Welcome to Passive Real Estate Investing with Mavericks, where we provide actionable steps for you to grow your passive income and become job optional. During this episode, you're going to get to discover the red wave. What's that all about? It's coming right up. Now, for those of you who are new, I'm your host, Neil Timmins. I love passive income from real estate. Before I connect here with Ava for another Freedom Financial Friday, I want to make a request that if you like what you hear, well, give us a thumbs up. Be certain to subscribe to the show. Never miss a valuable episode. If you love what you hear, give us a written review. Also, take a look at the description of this episode. We packed it with thousands of dollars in free resources. Well, it's Freedom Financial Friday. I've got Ava Bouwkamp here with me. We're going to be talking about the red wave. And just because we're having this subject matter, I wore all red today, of course.
You're so prepared.
to be in the theme. But I know some people are going, what in the world's a red wave? What's this about? So let's open it up. Let's talk, Ava, and let's dive into this because it's impactful for everybody, whether you're in real estate or not in real estate, for what's coming.
Yep, that's a great question. So I'll actually kick it off with a headline that I just pulled up from the Wall Street Journal. This was an article published on, let's check, the 6th of June, so just about a week ago here. And the title of this article is Interest-Only Loans Helped Commercial Property Boom. Now they're coming due. The subtitle is Landlords Face $1.5 trillion bill for commercial mortgages over the next 3 years. So with that in mind, Neil, why don't you describe how that ties in with what we're describing as a red wave?
Here's what took place. If we go back to the housing crisis, right, of that 2008 era, what was taking place in 2001 to 2005 is that everybody was doing these ARMs, adjustable rate mortgages, or interest-only mortgages. And while that was incredible during that time period, as soon as interest rates churned in late 2005 into 2006, when everybody's ARM, their adjustable rate mortgage, was up, their interest rates moved from, may have been 1% up to about 3%. So in some cases, practically doubling or nearly doubling, let's say, the interest that they were charged. Therefore, moving their payment dramatically higher. And then we all know how that thing rolled in the end. Well, when it comes to commercial mortgages, most, not all, but most are written on 5-year fixed rate loans. So they're like adjustable mortgages in this sense that you have a fixed rate for a defined period of time. Where it separates from an adjustable rate mortgages is this: at the end of a commercial loan, 5 years, it becomes 100% due and payable. It doesn't adjust. It just becomes due. And what commercial investors do is they typically just go out and put a new loan in place and keep rolling that forward, just accounting for it. And that's all fine and well until interest rates double, which is what they've done. And so there'll be a whole bunch of folks unable to refinance and move that debt forward. There will be properties headed back to the bank, if you will, properties sold on the open market at discounts from what they were purchased at. Hence, the red wave. People will be losing money.
Awesome. That's a lot of really good context. So if I'm as a passive investor, I'm hearing that all of these commercial mortgages are coming due. TREP data has put out numbers between the 46-50% range of all commercial mortgages are going to be due and payable over the next 3 years. So spread out over 3 years. I look at that and I'm not maybe as familiar with the commercial space. Are you suggesting that this will be similar to 2008 in terms of just a landslide of properties going back to the bank, or will this look a little bit different?
I think it'll be lighter than that. You think for one large material difference, houses back in 2008, there was a whole bunch sold to people who could not afford them to begin with and ended up with almost no money down in a down payment form, right? Commercial mortgages are different. You're anywhere from 20 to 30% down payment when it comes to purchasing a property. So while I think some assets will go back to a bank, most notably inside the office space, that will happen across the board, no matter the asset class. But you think there's a 20 to 30 to 40% margin that actually has to get eroded before it goes back to a bank. And so I think there'll be plenty of things just sold in the open market at more reasonable dollars and cents, more reasonable rates of return for all those investors who are left standing, if you will, which is the majority of folks who can budget and diligently go in and put a new capital structure in place for a really quality asset. It's not the asset that's a problem. It's a financial structure of the previous purchase that was the issue.
Great. So what I'm hearing you saying is we're probably not likely to see tons and tons of commercial properties going back to banks, but we're going to see sellers who maybe right now they're not sellers. They're just property owners who are going to be in a position where they have to make a decision because when they go to refinance that loan that's going to be due and payable in the next couple of years, that it's now going to refinance at a much higher monthly rate. And so they may not be able to actually retain that property in their portfolio. And so they're going to be put into a position where they have to sell because the financing terms at which they bought the property have fundamentally changed. And now it's not, quite frankly, the numbers don't pencil. And so their options are to figure out a way to make the numbers pencil or to sell that asset. Yeah.
And oftentimes to figure out how to get the numbers to pencil, that oftentimes will mean they have to write a check. They have to bring now more money down than what they originally put down when they bought the property in order to get the new financing in place. And you'll find a number of investors and or a number of investment structures, however they bought it, syndication or whatever it may be, that the investors are just unwilling to start writing checks to keep a property.
Can you talk about how that, we hear terms like debt service, DSCR. How does that tie in with what you're talking about for someone who might be unfamiliar with how debt service ties in with what we're talking about?
Oh, yeah. Good question. So you've got debt service, let's just call it a debt coverage ratio. For every dollar of net revenue, how about this? For every dollar of debt that is payable to the bank in a year, you must bring in a net revenue basis. I'm gonna use easy numbers, $1.20. So if it's, you pay the bank $100,000 a year in your loan, you must bring in at least $120,000 in net revenue, meaning I'm talking net, everything's paid for. So that's your bottom line. So in that scenario, the investor would retain $20,000, right? 120 in, 100,000 out, you retain $20,000. And so what happens is, if all of a sudden you find yourself where interest rates have doubled, that means your debt service, your payments are have increased. And that means in order to end up at a coverage ratio of 1.2, to maintain that, you either need to do one of two things. Your income needs to go up, which means your tenants have to pay more. And if you're in certain properties, your tenants, you may already be scheduled out 3, 4, 5, 10 years into the future to know what those leases look like. So you can't raise rent. And so that means your debt, i.e. the size of your loan, has to come smaller. And so that's where you end up with the scenario of investors may end up writing checks to reduce their loan balance in order to get their coverage ratio in line with the bank's requirements.
Awesome. So we've talked a bit about how interest rates have gone up. I think that's something that most people are extremely, familiar with that concept. Yeah. But for those who may not have an inside scoop on how these commercial mortgages are written, I'd like you to discuss a little bit about, okay, so Neil, interest rates are up. How does that actually impact commercial loans? What does that mean that the 5-year treasury is up? How does that actually impact my ability as a property owner to refinance my property? And now I'm in this pickle.
Yeah. So as long as, which is not holding all the way true, but as long as banks are active out there lending in the marketplace, and so we're finding some uniqueness now as a result of largely SVB and that collapse. And so you have plenty of banks whose deposits are running off. So banks are getting somewhat squeezed in terms of who's now actively participating from a lending standpoint. All right. So separate from that issue, we just have, banks have oftentimes, they take a 5-year treasury, well, call it, make up a number, 4.5%. And I'll put a margin on it, call it 2.5%. And all of a sudden, 4.5 and 2.5, 7. And so your new loan is now 7% fixed for 5 years, amortized over 20 or 25. And that's how it comes to be. And so when one is actively seeking a loan, you oftentimes talk to multiple lenders, find out and work your relationships, find the one that's best for you and move forward with that to secure that loan and put it in place.
Awesome. So we've talked quite a bit about some technical features, technical functions of this red wave. Can you tie back for me as a passive investor? What does this all actually mean in terms of my ability as a passive investor to, play my cards correctly over the next couple of years to really take advantage of these shifts in the market? Yeah,
I'll say your question. I'll state your question differently so we're on the same page. Hey, Neil, that sounds like super negative and it sounds like doom and gloom. But you're probably talking about this for a reason. How do I capitalize? Right? Is that fair?
Mm-hmm. That's fair. Good.
I think because that's exactly where we see things, right? As our ability to buy a really high quality asset that hasn't been able to, that may never have that hasn't transacted in years, let's say, high quality property with really good tenants, with a whole bunch of things you absolutely want to hold now and 5 and 10 and probably 15, 20 years from now. But it just requires a proper financial structure to put in place. So it'd be a whole bunch of assets that we would have passed on the last 2, 3, 4, 5, 6, 7 years because it didn't make fiscal sense at the time. And now all of a sudden, what is being presented is an opportunity to buy the asset that you want to buy at the economic terms, in a fiscal manner that you would buy it and put that in the portfolio and keep it. And that's the opportunity that's coming, is us to buy really good assets, because the asset's not the problem. It's a financial structure and the business structure of the previous investor who didn't properly account for something to go awry. And in this case, it was a macro economic environment that went awry on them.
Great. So obviously nobody can anticipate every single macro, micro event, but as a passive investor, I'm hearing you talk about it's not the property that's the problem, it's the financial structure. Right. So if I am a limited partner, I'm a passive investor reviewing a deal, how do I look at a potential investment opportunity and analyze it to make sure that the syndicator, that the general partner has put together a sound debt structure? How can I make sure that they've implemented shocks to make sure that my investment is as safe as it can be? Yeah, great question. It's asking the questions to go down that path. Explain the debt to me. What is going in place? How long is it fixed for? What's the amortization? Explain to me your thesis behind putting the debt in which you've chosen to put in place. Because even in today's environment, I see plenty of people putting
putting all sorts of debt structures from both very near term, very short leash, if you will, a year to 3 years in that debt structure in place, to very long term, as if interest rates are never going to come back down. So it's just asking that question to get the syndicators' thesis about why they're doing this and what their belief is. Then at the same time, asking the follow-up question, okay, when 3 years rolls off or 5 years rolls off, what have you predicted to happen? And have you tested that inside your numbers? Have you, where you were going, Ava, have you shocked that to go, if our interest rate is X right now, if we go X plus 2% or X plus 3% 5 years from now, where does that put you? How does that play out?
Or if our vacancy drops, or we're not able to lease at the rate that we've predicted. Yep. Those are some of the detailed questions that a passive investor should be asking any syndicator that they work with.
Yep. You're exactly right.
All right. Do you have any closing thoughts on the red wave here?
No, I think we've got, just to summarize, I think we've got a tremendous opportunity, a window of opportunity that will not last, because as you indicated, there is a large percentage of these mortgages across the country that are coming due and payable over the course of the next handful of years. We've got an opportunity to capitalize on the properties that become available, sound properties that work under today's economic environment and our structure going into it, and portfolio those. So I think we've got a window of opportunity to be able to strike, make it make sense, and put them in the portfolio and cash flow these and capitalize on the opportunity that's here. But it won't last forever. So I think it's bees. And if interest rates continue to rise, although not as fast as what we've seen, but if they continue to rise, which they're predicted to do through this year, it's going to continue to increase the opportunities that get in front of us. So kind of that bad news is good news. And so we keep our eye on the headline, because when opportunities do present themselves in the form of a transaction and building a property that makes sense, we're striking. And so I think you can do the same as a passive investor, but just finding the sound operators or the sound opportunities that make sense for you.
Yeah, that's great. My concluding thought is find someone who's got a long-term perspective. The way to weather these kinds of ups and downs and to harness the opportunities that they create is to make sure that you're in this for the long haul. You're not here as some sort of get rich quick over the next 3 years. We're really looking for those kinds of properties that are going to make sense 20, 30 years down the line. And for us, this seems like a great window of opportunity to identify, find, and acquire those properties, and then hold on to them for the long term.
What a great Freedom Financial Friday, Ava. I thank you so much for being here. And until next week, see you guys then. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.